Good afternoon, everyone. Thank you very much for choosing to spend a part of your Friday afternoon with us. This is yet another one of CW's Parishad webinar series. So at CW, we call ourselves the Council, which in Hindi translates to Parishad, and that's what this webinar series is called. Today, we're excited to be hosting the India launch of the 2020 IEA World Energy investment study. But also we have an illustrious panel with us to discuss the investment outlook in Asia in the wake of the pandemic. And this is something, of course, there's a lot of we all have a sense of the sentiment, but the IEA has done an empirical analysis to translate what that sentiment really looks like. And so we're going to hear a little bit about that and then see what that really means for India. Before we get started, I'd like to invite the CEO of the Council on Energy, Environment and Water, Dr. Arnaba Ghosh, to please say a few words.
Thank you, Kanika. Good afternoon, everyone. I'm Arnaba Ghosh, CEO of the Council on Energy, Environment and Water. Delighted to be hosting this webinar with the IEA, at which, as Kanika just mentioned, we will hear about the results from the IEA's latest report. CEW and the IEA have been collaborating now for many years, and every year we are trying to deepen that collaboration. It extends from renewables to investment trends to industrial decarbonization and so forth. In fact, the annual CEW IEA Renewable Energy Investment Trends report for this year is under preparation, and we hope to bring it out later in the year around autumn. So today, just to set the context and to welcome you, as Kanika said, you are all spending a part of our Friday afternoons. We could, of course, cynically say, what else would we have to do? But if we actually put our thinking hats on, even at the fag end of the week, the interesting question before all of us is, does anyone have a crystal ball with regards to where energy investment will go? Because energy investment is the key kind of fuel, as we like to say in CEW. There are two fuels in any economy: energy and finance. So energy investment is where these two fuels come together to drive economic growth in the economy. So our understanding of energy investment itself is contingent on our understanding of where the economy is and is likely to be headed. Just yesterday at CEW, we had a senior cabinet minister, Minister Nitin Gadkari, release our latest report called Jobs, Growth and Sustainability. I'll just hold that up. You can see that there is a little bit of a ray of sunshine coming through the keyhole in trying to signal the optimism. But the key message was that in trying to drive the economic recovery, we will need a new social contract that rests on looking at jobs, growth, and sustainability on one hand, and preparing ourselves of becoming more resilient against what we call tail end risks, risks that have very low probability, but have very high devastating impacts. How does that message fit in with what we want to discuss today? Energy investments are capital heavy. They require a lot of people, a lot of institutions to put their faith and their kind of leaps of faith into large infrastructure investments, whether it's in fossil fuels or in renewables, or somewhere in between, and which will yield returns over a long period of time. So when perfect storms of shocks come and hit these infrastructures, this is the kind of tail end risk that at least the energy industry and the financial industry has to prepare itself against. So during this webinar, we hope to, and I'm looking forward to the conversation, the presentation, and then the conversation that Kanika will moderate. But this is, for me, the really big question: that do we have even a sense of what the crystal ball in energy investments is likely to tell us in driving more jobs, more growth, and more sustainability? I also want to finally say that in just a little over a month from now, the CEW Center for Energy Finance is going to turn 1 year old. The first year is always very important for any baby. It's kind of, the hurrah moment that we survived. And if we survive 1 year, we can do a lot more. And Kanika and our team have been driving a lot of work, a lot of exciting work at the CWSF. So in the lead up to that first year birthday, we are going to have a series of webinars, Parishad webinars, but also many other engagements about which you will hear in the coming weeks. This webinar with the IEA is simply to kick off the birthday celebration. So thank you very much for joining us. Kanika, over to you.
Thank you. Just, picking up from where Arnaba left off. So when we launched the Center for Energy Finance last year, Dr. Fatih Birol was with us to do the actual launching, so to speak. And he actually offered, and he said, oh, this is a really important initiative, and he offered his support and help. He didn't think we'd take him up on it, but in this entire past year, we've been very happy collaborators with your entire team. But before getting into the substance of the discussion today, if I could please invite Tim Gold, who's the head of energy supply and the investment outlook division at the IEA, to please also give us a little bit of context of this report.
Well, thanks very much, Kanika, and thanks very much, Aranaba, for that introduction. We're delighted to be working with you on this latest in the Parishad series. Congratulations to you on the birthday of the centre. We've attached a lot of importance to our collaboration with both with the centre, the finance aspect, and also with CEW writ large. We've enjoyed that greatly over the last year, and the regular reports on the clean energy investment is an important aspect of that. But as Aranaba said, it's a very wide-ranging set of issues that we discuss with you. I remember fondly discussing all sorts of India-related outlook issues when we did the 2015 special report on the India energy outlook. We're updating that this year. We have ongoing collaboration also on some energy water issues, which, as you highlight in this new report, that's also a critical vector for India. And just to say, congratulations also on the release of the new Jobs, Growth and Sustainability report. For us, this is now the critical issue on which we are also engaging with policymakers across the IEA family. Next week, on the 18th of June, we'll be releasing our own analysis of sustainable recoveries, and it will, of course, it won't have all the specificity that you have for the India situation, but we are trying to also make those connections with policymakers across the IEA family. Just a word of broader context, if I can, on the IEA-India relationship, because we've been working very closely with Indian policymakers throughout this crisis. Institutional level, as many of you may be aware, we're working together towards a new strategic partnership between India and the IEA, which will be a testing ground towards potential IEA membership status. We're delighted that Minister Singh was able to participate in a recent ministerial roundtable on economic recovery through investments in clean energy. And we're hopeful that we may have also ministerial participation from India in our upcoming Clean Energy Transition Summit, which takes place in a few weeks' time, and which in our view, and also in the view of the UK presidency, that's a really one of these key multilateral events on the road to next year's COP26. A bit of context on the World Energy Investment Report, because under normal circumstances, we would now be telling you about all of the interesting things that happened in 2019 and trying to convince you that a 2% drop here or a 3% rise there are the crucial indicators to watch out for. But of course, we're not living in ordinary times. We're not talking about single-digit movements in some of these critical investment indicators. And so the picture that Mike and Lucilla are going to present to you now is quite a troubling one in many ways, because we're talking about a transformation, the need for a transformation in the global energy system, which will require large capital investments. And of course, in many ways, if there's no action by policymakers to stem that, to stem the disadvantages of the current situation, you know, you could see a slowdown in that transformation with all that it implies for future emissions and for the nature of the economic recovery. So we're extremely pleased at the chance to discuss these issues with you. Many thanks to the distinguished panelists that you have assembled for us today, and many thanks to all those who have joined us for this event. Back to you, Kanika.
Thank you very much, Tim. So jumping right in, for those of you who have read the report, or at least parts of the report, you realize that as Tim just outlined, these really are unprecedented times. I mean, this is something that, you know, has become a glib statement that all of us have been using in many different contexts. But actually, when you read this report, you realize that empirically that's true as well. These are unprecedented times. So, you know, never before has the world seen such a large drop in energy investments. And for me, I think the data point that really stuck out was how consumer spending on electricity was greater than consumer spending on oil for the first time ever, right? And is that really a sign of a changing paradigm, or is this kind of the lockdowns that the world has seen, are they really going to result in locking us in longer into sort of more traditional and fossil-rich energy sources? So to respond to all of those questions and more, I'm going to hand over to Michael Waldron and Lucila Arbolea, who have both been important authors and you know, part of the team that has put this analysis together.
Okay, thank you very much, Kanika, and thank you both, Renaba, for your opening remarks and hosting us. Also, Tim, for your remarks. So I'm gonna go step by step here. So I'm gonna try to share our screen here, and hopefully the presentation as well.
Yeah, we see it.
Okay, you see it. Okay, great. So I think it works, and I'm gonna try to bring this. Whoops. I can't see it actually. Here we go. Okay, now I see. I had to minimize the videos. So thank you very much, everybody, and thank you for joining us this afternoon. This is the 5th edition of the World Energy Investment Report. So we've been doing this report now since 2016. This has definitely been the most exciting one, I would say, from the standpoint of what's going on in energy investment and energy finance. And as Tim said, normally we're looking at the previous year, so we'd be looking at 2019. In this report we still do, but we have a good emphasis on what's going on in 2020, trying to take into account the latest available data that we see from the companies, from the governments, from the financial flows through about mid-May. So for those who are not familiar with the report, the structure of it, and again, also the structure of this presentation is based around first understanding the capital expenditures occurring in different energy sectors. So we broke those down roughly between fuel supply, the power sector, and the end use and energy efficiency sectors. We have a section in the report just focused on energy financing and funding trends. We also have a section focused on research and development and new technologies. I mean, we can talk about maybe in the Q&A some of the kind of macro uncertainties and some of the assumptions we have that go into these investment analyses. But what I would note at the outset is that if we sort of go back in time, and it seems like a long time ago actually, before the pandemic started, we were looking at the different company plans, guidance, government plans, projects expected to come online in 2020. And we said to ourselves, it looks like it's actually going to be a pretty good year for energy investment. So we expected that energy investment would grow about 2%. 2% seems very modest, but given that energy investment had been declining every year since 2014, 2% growth actually represented potentially a milestone and potentially a turning point in certain sectors, with total energy investment around 1.9 trillion. So we've gone from this expected increase in 2% to a decrease of about 1/5. And the cuts that we see in energy investment are very much concentrated first in major producers of oil and gas. So the United States, Middle East and North Africa, Russia and the Caspian. But we see cuts in all regions of the world, even in China, which has weathered the crisis relatively well compared to other places in the world. in putting it all together, we see energy investment down by almost $400 billion. So it's an unprecedented fall, the largest in the history that we've been able to track. And in the rest of the presentation, we're going to kind of dissect some of the underlying trends and some of the sectoral features behind that, and also talk about some of the potential pathways to get through the crisis. So one topic that's already come up is this spending, this revenue situation for different companies in the energy sector. And when we're looking at the investment cuts that we see, this 20% cut, there's basically two kind of vectors that are driving these cuts. The first is very sort of on the practical side. So disruptions to labor, to equipment supply, to supply chains, project development. This is as a result of the sort of physical disruptions associated with the lockdowns and the restrictions that we've seen in many countries around the world. So that's one factor. The other factor is more economic related. So when we're looking at the potential revenue hit to different companies around the world, we found that 90% of energy revenues typically go to oil and they go to electricity. But as Hanneke pointed out before, what we expect in 2020 is for the first time that this relationship would be reversed. So about a $1 trillion fall in expected revenues being available to companies and governments in the oil sector, a fall as well in electricity, which is also notable because electricity revenues usually are quite stable. But nevertheless, we see the hit to the electricity sector in terms of the financial impact to be relatively less than oil. Of course, there's many differences in many different countries. What's going on in the distribution system in India can be different than what's going on in for major utilities in the US and in Europe, and I'm sure we'll get into that into the Q&A. But at a high level basis, this reversal is quite stark, and it explains a lot of the reductions in investment, the expected reductions that we see in 2020. It gives you a very good idea as to why the oil and gas sector we see falling by about 1/3 in terms of capital expenditures. Relative to that, power, which we'll dissect in a few slides, seems to have a much more moderate fall, but we also see double-digit percentage declines in sectors like coal supply, and then energy efficiency and end use, which is very broad, but is related to downturns expected in construction activity and automobile sales, and also industrial activity, which are the primary sectors for end use and the sources of the investments in that sector. So kind of delving a bit deeper into the different sectors. In the oil and gas sector, what we've done is we've tracked all the major companies and we've assessed their expected or their revised CapEx guidance for 2020, and also made our own sort of judgments as to how solid we think that is. So all companies around the oil sector are expected to suffer. With the downturn in the oil price, the sharp downturn in the oil price and reduction in demand expectations, what we see is that companies are reducing CapEx guidance anywhere from a quarter to upwards of 50%. Some companies and some sectors are particularly hard hit. I would say the US shale sector, which is dependent on the constant drilling of new wells and also access to short-term debt finance, is particularly hit, and they suffer CapEx cuts of up to 50%. And one big difference for the oil and gas sector today versus 5 or 6 years ago when we saw a previous oil downturn is that in the previous downturn there was good room to cut costs. Now, much more limited scope to cut costs and improve efficiency, and a lot of the reduction in investment is translating into reduction in activity. So what does this mean for oil markets? When we're looking at the reduction of activity, it's not going to have an impact on production so much this year, but maybe several years down the line. So if we look at 2020 and we say, okay, what could be the impact on the oil markets or oil supply in 2025, it translates into a loss of about 2 million barrels a day. Of course, with uncertainty and also uncertainty over the ability of companies to ramp back up investment without the right price signals or market signals, it could be possible that we see lower investment for longer. So we modeled this and we assessed that if investment in oil and gas stayed lower to 2025, you could have the loss of some 9 million barrels a day. Lots of uncertainties over the demand picture and how well demand may rebound with the recovery. But what this picture tells you is that potentially there's potential tightness ahead in oil markets if demand did recover and investment did not. But volatility may also be a feature as the oil market tries to adjust. Now, with that, I'll turn it over to my colleague, Lucilla, who's going to explain some of the trends that we see in power.
Thank you, Mike. So when we look at the power sector, the drop that we expect for 2020 is less dramatic. It's a 10% drop compared to 2019, as Mike showed in our previous graph, and that's around $80 billion. But this is still a warning sign because the power sector is very much at the heart of the clean energy transition and development goals. So this is a warning sign for the sector. Mike, if you could please click. Yeah, so on the right, what we do is to look at the cumulative changes since 2015 to 2020, because what we see in 2020 is that what happens is that actually some of the trends that were already taking place in investment in the power sector globally are intensified or continued. And this is particularly true, for example, for investment in coal power, which is the brown series, or gas power, but also very true for electricity grids. But then there's also other things to highlight. One is the investment in the renewable sector, which seems to be less of a trend and much more of a direct impact of the economic crisis unfolded due to COVID. The impact in the renewable sector is around 10% globally. And this is, again, sort of more resilient than what we see in other sectors, particularly fossil fuels, but still very important because of what it means for sustainability and sustainable goals, given that when we look at investments in 10 years from now, annual investments should be doubling and not reducing. So going into the next slide. So when we focus a little bit on energy investment in Asia, and what we show here is on the left, we show investment in India, and on the right, we show Southeast Asia and other emerging and developing Asia, excluding China. And the story is similar, again, an expected drop in 2020, but with some more specific things. Mike had mentioned two vectors, one being the practical vector affecting all of this, and the fact that the lockdowns have reduced demand and the ability to complete installments, but also one specific thing that is happening in these regions too is the fact that the public sector and state-owned utilities or national oil companies are also big players in the energy sector, and therefore with low growth and with fiscal constraints, we expect that these companies will be less able to invest from their own balance sheet, but also to issue debt and to issue it at a low price. And at the same time, in many cases, these companies are the main counterparties to private actors, and therefore this will be affected. And again, the drop that we see in 2020 is particularly important because when we look at the sustainable needs in a decade from now, they're sometimes 2 or 3 times the current levels. So the drop in 2020 is again a concerning sign. So moving to the next slide, we've also done analysis on sort of some specific technology underlying stories, and one thing that we've looked at in time is the final investment decisions, and this is the approvals of capacity for coal power plants in the world. And what we see is that, so this is on the y-axis, what you see is capacity, gigawatts, and not dollars. And what we see is that there was a downward trend very much. If you calculate the reduction between 2015 and 2019, we see an 80% drop. That is due to various reasons, some regulation, some overcapacity in specific countries, and also the lack of or the reduced ability to finance these type of technologies. But when we look at information of the first quarter of 2020, what we see is that the approvals for coal power plants have edged up. And when we annualize this, we see that it would imply a rate of twice the level that we saw in 2019, and this is coming from approvals in China, but also other places in Southeast Asia and South Asia. And maybe going to, of course, the previous slide, what it meant is like this would have implications on the clean energy transition, and this is precisely what we show in this graph, but specific. So here we show the universe of investments in terms of technologies that are either clean energy investments or energy efficiency. And one message from last year's report was that the investments in this universe were stable at around $600 million. Of course, they are expected to lower in 2020, but it must be said though that the fact that they are stable, given that there's been reduced cost in various of these technologies, particularly renewable power, means that in many cases, sometimes there's more deployment for the same dollar, but still concerning because the message last year was that the ratio of clean energy and efficiency investment over the total investment was around a third, and it needed to go up to 2/3. And this is not happening. We do see actually the ratio increasing a little bit to less than 40%, but it's not for the good reasons, in the sense that this is not because of a strengthened investment in clean energy and efficiency, but more because of weak investment in fossil fuel power. So I think that moving into the next slide, another story that we look at in the report is the ownership and who is financing different technologies across the energy sector. And here we separate between technologies and segments of the value chain, but also between countries, looking at how advanced economies, and it must be said that the rate is emerging and developing economies, how it differentiates between those. And what we see is two key takeaways. One is that the role of governments and financiers the public financiers is more prominent in emerging and developing economies. And second, that some sectors are less reliant on public funds and public actors. And that is very much the case for the sector of renewables and energy efficiency, where the private sector is much more prominent. Of course, these public actors, as I said before, do depend on incentives and regulations set by the public sector. And last, the fact that in advanced economies, they do have a sort of much wider and varied pool of resources and funds to access, and that is what Mike will be discussing a bit more in this very last slides.
Yeah, thank you very much, Lucilla. And the last few slides will kind of deal with this question, which I'm sure we'll discuss in the Q&A. I think everybody recognizes that to scale up investment, particularly to scale up investment to support energy transition, you would need a lot more private sector finance. And in particular, you would need more finance coming from the investor community. So one thing we looked at is we looked at a bit more at the role of the capital markets in energy investment. And we tried to assess some indicators to understand, what are the prospects for investment in different parts of the energy system from the debt and equity capital markets. So this picture right here shows you some joint analysis we did with the Imperial College Center on Climate Finance, where we constructed equity portfolios in Europe and the United States, and looking at their relative performance over the past decade. What we found is that it's first of all, it's very hard to build a pure play equity portfolio for renewable power and then to compare it versus fossil fuels. But to the extent we're able to do this, we found that over the past decade, the renewable power portfolio delivered higher returns with less volatility than the fossil fuel supply portfolio. Of course, a lot of this gain or a lot of this advantage came in the past year, 2018, 2019. So it didn't necessarily reflect the trends up until that. Perhaps even more interestingly, when you look at 2020 and you look at the general downturn in market, it seems that renewables have done relatively well compared to, of course, the fossil fuel portfolio, but also the market in general, likely due to some of the sort of revenue features associated with renewables. But still, it's a difficult thing for investors to allocate capital to the sector, given some of the scale and liquidity constraints inherent in the companies. Another route that we see investors playing an increased role is directly in the financing of projects. But they're more concentrated in the refinancing and acquisition of projects rather than providing equity upfront or equity during the construction phase. So institutional investors are typically more comfortable with devoting capital in the refinancing stage. And here we've looked at refinancings and acquisitions. This shows you sort of big energy supply projects, whereas smaller scale projects related to distributed PV or efficiency, that would be more captured in some of the data we looked at on securitization. But here the trend is interesting because it shows a rising role of investors, a relatively rising share of investors trying to refinance renewables in particular, which is something that we think helps to give more confidence to the market and lower the cost of capital. But by and large, based on the deals that we're able to track, which is available deals, it appears most of this activity is occurring in advanced economies, and there's still quite a bit of scope to advance or to expand investor participation in the emerging economies. And then the last substantive slide I'll conclude on before going to our general conclusions just shows you some of the indicators we're tracking in terms of the debt markets. And so there's a big trend right now globally with the issuance of sustainable debt. We've seen rapid growth, and at the same time and this includes things like green bonds, but the sector is also diversified in terms of the types of instruments, which are starting to serve a wider range of corporate sustainability goals, whether these are based on activities defined in the bond agreement or more performance-based, such as sustainability-linked debt, which has grown quite fast. These are very appealing to investors who are looking to meet sustainability goals in terms of their capital allocation. But nevertheless, the sustainable debt still represents a small fraction of the overall debt markets of some 5%. What these instruments are doing is they're helping primarily to refinance, but also add new finance to renewable energy, energy efficiency, and end use, and also support corporate environmental goals. But nevertheless, we still haven't seen the type of scale up to make a big difference in terms of capital expenditures. So capital expenditures for the clean energy technologies, as Lucilla has shown you, have remained relatively stable at the same time that these sustainability debt markets are rising quite rapidly. So with that, I would leave it in terms of the substance. I would just note some of our conclusions and emphasize that within the investment report, we see a number of sectors affected, particularly oil and gas industry. Electricity grids is another area of warning sign that also perhaps we could discuss in the Q&A. And this progress towards clean energy investment in the clean energy transition, which even though the shares have gone up in 2020, the absolute numbers are going in the wrong direction compared to what they need to go. This is also reinforced by recent IEA analysis related to the Tracking Clean Energy Progress report, which also gives more of a technology by technology view of different deployment trends, which I would also encourage you to look at. So with that, maybe I'll turn it back over to Kanika for the discussion, and I will try to exit our presentation.
Great, thank you, Mike and Lucilla. So for all of you who are attending, please feel free to use the Q&A chat box to write in your questions, and that way we can make this more interactive. This was, I think, the very sobering presentation of the things to come, and the recovery will be long. And unfortunately, from a Paris Agreement lens, or from an overall climate change and sustainability lens, we don't have the kind of time that is required if you think about sort of what a natural recovery would look like. So I'd like to also spend some of the time in today's discussion thinking about accelerators to this recovery. But before that, if we can just start about thinking about how this compares, this sort of global outlook compares with what's happening in India. So maybe I'll start with you, Vandana. So Vandana Gumbar is the Global Policy Editor for the Bloomberg New Energy Finance, and a keen, I would say, observer, and provides very interesting commentary on sort of the clean energy transition as it's unfolding in India. And Vandana, maybe if I can just, ask you sort of a kind of catch-all question to start with, to think about what are some of the challenges that for the clean energy transition that the pandemic has exacerbated, or new challenges that it has posed, if you look at it from an investment outlook point of view, and how, I mean, sort of how does that compare with what Mike and Lucilla just presented?
Okay, hi everyone. I thought that was a really interesting presentation, and since at Bloomberg NEF we focus a bit more closely at the renewable energy space, I think it was the second last point of your concluding slide, which kind of said that clean energy investments have been relatively resilient, which is very positive, and which is what we are seeing in the market. So my colleagues basically are yet to internalize the impact of COVID-19. We are working with 3 scenarios. We are working with a single wave pandemic, a multiple wave, or an enduring pandemic. So all the numbers that we are putting out right now, we put out a wind outlook today, is kind of giving 3 scenarios, and we have a long-term outlook which is in the pipeline. But I think the broad headline that we're seeing is that power demand is down, and that will have an impact on investments. But I just wanted to share 3 projects here. So I began looking at this sector thinking there is going to be an impact. There's going to be an impact on projects in the pipeline. There will be the possibility of some projects being canceled. And so I just wanted to share 3 developments of 2020 that make me very positive about the outlook. And these are 3 developments of June 2020. So this month, we had Seagreen, an offshore wind project in Scotland, achieve financial close. It's 1 gigawatts plus, 2 ECAs participating. It's EKF of Denmark and GIEK of Norway, and this happened after the pandemic. And I have been speaking to some of these export credit agencies, and I have been speaking to people who are trying to close these transactions, and there are more offshore wind financings that are going to close in 2020 is what we are hearing. So that's the one positive thing. The second thing was I was looking at green energy PPAs, the direct purchase of power, and they are completely well hit by the pandemic. You have a mall which is buying solar energy, and there is no operation at the mall. You have Delhi Metro, zero consumption of power. The PPAs did not envisage a situation of zero consumption. So you have the force majeure clauses, you have a lot of lawyers involved, you're trying to see how to figure all this out. And again, in June 2020, this month, you had an announcement from Amazon announcing 615 megawatts, I think. Yeah, 615 megawatts of new projects in 3 countries, US, Australia, and China. And they are still sticking to their RE100 commitments. In fact, they're actually, well, Amazon is kind of one of the companies which is doing well in this pandemic, but they're talking about 100% renewables by 2025 instead of 2030, which again also tells you something positive about the corporate PPA market. And lastly is the India announcement from Adani, the 8 gigawatts plus 2 gigawatts manufacturing link tender. Again, something which has been signed this week. And I'm there might be hiccups in developing 8 gigawatts of projects over 60 months or 2 gigawatts of manufacturing. I think they're supposed to do it in about 2 years. But the fact that they have signed on, they've taken on this commitment, I think that over the long term, and perhaps even over the medium term, perhaps this is a sector which will continue to remain relatively resilient. We have put out a report, which I mentioned at the beginning, just on 10th of June, which is on our website, which is actually talking a bit about the impact of the pandemic, but looking at the largely at 2019 investments. The numbers are a bit different from what IEA friends have shared, because they are including some things that we do not include. But essentially what that report is saying is that the fundamentals remain strong. You still have economics working in favor of renewables, and you still have commitment to green, which has not gone off the table. And you still have these companies who still have their sustainability goals. I mean, I'm much more positive about the outlook for this sector compared to many other sectors. Yeah, back to you, Kanika.
No, I think that that's absolutely true. I mean, if you think about in the Indian context, if I can add one more example to your list, Vandana, is the round-the-clock tender that was just also recently concluded, which actually takes sort of, I would say India's energy transition story, while very robust in the last few years, has been very much a generation asset kind of story only. Whereas this is actually in some ways both the manufacturing link tender as well as around the clock kind of, moves a little bit into the broader ecosystem development. So I think that there is, of course, you're transitioning towards thinking about ancillary services, about storage, about hybrid. And if that is something that was, completely opened and closed within the time of the pandemic, and then if you also think about a lot of the policy signals that are coming out for the sector, things are much less bleak, I would say, for this sector as compared to others. But Prashant, I think I'll use that to go to you, where you have real, skin in the game and dollars invested, which are currently probably suffering. So maybe to hear from you what you think are, some of the lingering challenges, because, it wasn't all rose gardens before COVID-19, but also how have they gotten worse or better in light of the current crisis?
Yeah, hi Kanika. I couldn't agree more with Vandana that the overall uh, environment for renewable remains intact, and it's also true that the energy intensity to the GDP is not going to change even during this pandemic or the period after this pandemic. However, it's for sure that GDP on the whole is going to contract, and if it is going to contract, so will be the energy requirement. Having said that, India was traditionally being energy deficit country, always looked for alternative energy sources, and renewable has come as the most competitive as well as has got the environment value. So the overall investment scenario in renewable hasn't changed much, will pick up fast. But the problem here is capital, and that's the real capital. Capital, which I say both in terms of equity as well as debt. Just to give you the number, if we have to meet the targets, or if we have to become self-reliant in terms of energy, and if electricity vehicles are going to become a reality, this country needs at least 15 to 20 billion dollars of investment into renewable every year. From where on earth this kind of capital would come? The energy, the green bond which IEA presentation showed is virtually non-existent for India. There are a couple of developers like Adani's or Greenco's who have raised these bonds, but then for the larger market, it has been non-existent. And even if you see these green bonds, which are available just for 10 years, 7 to 10 years period, now you need a long-term capital. You need to mimic the repayment schedule with the payment cycle of the project. So you need somewhere between 17 to 20 years of patient capital. That can't be serviced through green bonds, because if on the 10th year a situation like COVID happens and the market completely dries up, all those bonds will default. So there is a need from the policymakers to address this, where the patient capital has to be made available to the sector, which at the moment is completely non-existent. Bankers are still not very open funding renewable projects. There are few NBFCs as well as specialist financiers like IREDA, PFC, and REC who are funding renewables. Barring them, there are none. Okay, so capital looks to be a great challenge here. Equity still has attracted capital in renewable, but debt has failed to attract capital into India, primarily because of the rate expectation. So and if you just go back and just try and see that how much of bids have been announced, one, and how many projects have been surrendered, you would really find what I'm trying to say. There are many projects which didn't find financial closure, both in wind as well as in solar, and those projects were surrendered. So that's the problem I'm talking about. Going forward, the major players in renewables are only going to get more stressed and leveraged, and that is where country needs more player both in equity market as well as in debt market. So that's my take, Kanika. Over to you.
No, I mean, I could not agree more, Prashant. I think even though globally we've seen, and this is what the presentation showed as well, right? So, some of the sustainability linked investment vehicles have actually done much better. Their investment outlook is better, but then in an economy which has really a bond market of no significant depth, and it does not have an investor class that rewards sustainability or green rating, how do we overcome this over-reliance on bank debt, especially in times where liquidity is going to become much more constrained? At the CW Center for Energy Finance, we're actually currently in the process of designing one such sort of credit enhancement based instrument, which can actually do exactly that, which leverages some small amount of public money to then create this, an asset class that does find local currency capital market investments rather than just, hard currency investments, as we've seen the ones that you mentioned by some of the other issuers where they've gone to bond markets overseas. But maybe if I can ask Mike and Lucilla to also come into the India-specific discussion a bit. I mean, also drawing on some of our experience of doing the investment trends work that we do together. How do you think India's experience with this kind of the COVID recovery is going to be maybe different, or in some ways possibly better or worse? So what do you think will be the serious points of deviation?
So in many ways what we see, and maybe I'll be discussing sort of my answer will be a bit focused on power, but what we see in India, when we look at risk or perceived risk in India, in a way they're very similar to what we see in other developing countries, and this is mainly risks around revenue risks and the financial and operational sustainability of the state-owned utility, and the fact that maybe collection and billing is low, and issues around planning and oversupply and onerous contracts, and also in terms of regulation and bankability of PPAs. But the interesting thing in India, which in a way it's such a large market and big that the problem can also be much bigger than in other economies, but at the same time, it is a place where in some states we see some positive or more positive developments, which could, I think, very much be an example for other countries. And even when we talk to other developing countries, I think India is a good example, and in a way, it's a much better example for other developing countries. In terms of, and maybe one specific point, I think that the one thing is like a lot of this risk, as I think it has been said, were already existing before COVID. So the big question, I mean, there are sort of big long-term issues which are to a large extent the most binding constraint in the case the sustainability of the utility, which because it finances a lot of the assets, but also because it's the main counterparty, in this case, it's DISCOMs. But those are things that will take time, and we need results now, very much now. So I think that one thing that we've discussed that is something that can be done, and there is capacity in India to do this, is to work on all of the issues around preparation, either permits on land ownership, or issues that do not require substantial resources, money, or substantial people, or most importantly, changes in regulation and policies. So sort of very quick wins that will not solve the overall sector, but they may be important benefits during the COVID pandemic. And this is, and I think some of this has been discussed in India, and I think it would be a great example for the rest of the developing world.
Maybe just a few other points to add on top of that, also taking into account some of the messages that we've had in our joint work in the past. I mean, some of that analysis that we've done is noted kind of the market concentration of the different developers who are winning awards. There's a pretty high concentration of relatively few developers who are winning awards year to year in solar PV and wind. I mean, this differs by the sector. So this definitely speaks to the need to introduce or to have more players involved. We've also analyzed with you sort of the location of these different players, and there is this need to bring in more international capital and more international IPPs outside of those who are just kind of stationed offshore in India and who may look like international IPPs. Fully agree on the need to develop a more rich and deep corporate bond market. I would maybe question this notion of having sort of 17 to 20-year debt available. I mean, when we look at other markets around the world, when we look at Europe or the United States, I mean, these types of terms of debt aren't really available anywhere. I mean, the availability of long-term debt globally is very difficult to come by. This is the result of the previous financial crisis and some of the kind of prudential capital requirements imposed by central banks. And I'm not sure if this crisis is going to change those sort of financial regulation rules or make banks even more willing to make available very long-term debt. And so we could be in a new reality where long-term infrastructure projects are going to have to make do with shorter debt terms, hopefully with lower cost of capital because of financial availability, but also trying to crowd in more low-cost equity. And here, the very high cost of equity in India, I think, is a big barrier. So any ways to explore, kind of as you said, that creating that investor class to bring in more equity into the system, I think would be valuable.
So I want to move, I'm conscious of time, and I do want to get thoughts on sort of financing the broader ecosystem, as well, sort of, investments into energy storage, into grid upgrades, into transmission. But I do, before that, want to say that, all of this conversation around terms of debt as well as equity returns very much, of course, hinges on the risks, right? And so while we have no short amount of the risks that plague the flow of capital into renewables in India, one of the risks that we did not ever have was demand risk. Because we were, well on this growth pathway, and it was as if the power sector would never stop growing. And it was almost that the India's energy transition would actually be very much, like in many other parts of the world, be driven by decarbonization of electricity, and we would electrify a lot of end-use sectors as well. And then, of course, there would be more expensive sort of like renewables, hydrogen, and other things that would come in, but the bulk would come from decarbonized electricity. But what we have seen in the last few months, and of course, I understand that we're in lockdown, and so the dip in electricity demand is likely to come back up. But is the slowdown in industry, is the slowdown in overall economic growth going to now mean that demand risk is going to be a risk that India has to deal with? And I'd like everyone actually to weigh in on that. So we'll start with you, Vandana, and then Prashant, Tim, Lucilla, Mike, and Arnava, in that order.
Okay, well, thank you for that million-dollar question to which there is no serious answer. I'm afraid we haven't really, we are still in a very fluid situation, still trying to figure out where we will all end up. And I have a lot of sympathy for my colleagues, analysts who are trying to model this and work with different scenarios. So I think that the broad thing is we are obviously seeing an impact on demand, and obviously India will be impacted as well. But from some of my colleagues who looked at Hubei in China, I think power demand was back up at a higher than trend level. So there can be multiple explanations for that, but I mean, I don't think there can be anything definitive said as yet, and we haven't really finalized any numbers that I can share with you. Sorry for that really short answer.
That's good. Prashant, is demand risk something you're factoring into your decision making now?
So we don't see a long-term impact of on demand because of this pandemic. It's transitory in nature. There will be a contraction for sure. As I said, that energy intensity to GDP is not going to change. So if GDP is contracting, so will the demand for electricity. But we are very optimistic on demand side. We don't see this as a permanent loss. It's just transitory in nature, and going forward with electricity vehicle picking up and sensitivity towards environment only going to go up, electricity is going to take the market share from coal, oil and gas, and of course other mediums. Okay, so I'm not worried about demand per se. I'm more worried about how to fund this demand. There will be a period when demand will exceed the supply, at least in India, and that situation will come soon. So we need proper planning for that.
Okay, that's a good outlook so far. Did you want to go next, Tim? I forgot the order I said, so now I'm just going to call on whoever I said.
Sure, I would only. Okay. Yeah, happy to say a few words on that, because that's one of the issues that we're really wrestling with when we're trying to structure now the new India energy outlook, which we're doing again probably for publication in the early months of next year. One of the key uncertainties for us is the broader economic impacts of COVID. You know, most of the planning thus far, we've always been relatively downbeat on the outlook for GDP. So we've never particularly believed in the idea that we would see a V-shaped recovery. But I think we do need to have in the back of our minds the possibility that we have something that's like a W shape, where we do have a second wave of infections later in the year because economies open up prematurely, or the social distancings are not observed, and so on. And that would have a long-lasting impact then on GDP, and it would affect the rate at which we get back to those previous kinds of trajectories. And it may mean that a sort of permanent loss in some cases. So I think that aspect of the demand picture needs to be in the back of our minds. That said, of course, in India, you know, there are very strong reasons to believe in the robust underlying drivers for demand growth. But you know, this crisis, particularly given the way that electricity demand has been over the last few years in India, I mean, it does raise some questions, shall we say?
Yeah, Mike and Lucilla. Because the thing is, we traditionally tend to overestimate our electricity demand growth anyway, and that has happened for the last few years. But it is the curve is definitely on the up, and I think that it's really I'm wondering if you think there'll be a plateau at least for a year or two, or if you think that it's just the rate that's going to decline. So yeah.
Yeah, I mean, it's a tricky question to go beyond this year. I mean, in the Global Energy Review that was released in April, I think we had India's electricity demand down by something like 5% in 2020, which is of course unprecedented. Maybe just 2 points I would raise on the back of that and turn it over to Lucilla. One of the things we tracked, or we noted in the investment report, was the turnover of the capital stock. So looking at how additions and retirements of different parts of the energy sector compared to the flows compared to the stock of goods. And of course, this has implications for running old power plants perhaps longer for economic reasons, but it also has implications on the demand side. India has made very good progress in terms of energy efficiency for various reasons, because of government-led programs, but also state standards for things like buildings. But when we're looking at the impact of economic growth on things like new construction, on the ability of consumers to go out and purchase a new air conditioner unit or a new automobile, all of those things are sort of the risk are more to the downside. So the structural improvements in efficiency do have the potential to stall if they're not backed by sufficient policy measures to keep them going through the crisis.
Well, I think that a little bit like what others have said, I think in the long term, I would expect that the demand will pick up. The issue is always like, when does the long term arrive? And I don't think we have that answer. But it is very clear that even at the beginning of the year, when we started with the report, we've all been updating expectations downwards and even choosing the GDP assumptions that we had, which at the time seemed potentially pessimistic, but now very much more realistic, and even it's yet to see what happens. So in that sense, the answer is yes, I would expect demand to go up, but the problem is very much what happens while we wait for that, and in terms of investment, but also industries, how will, in the case of India, I think that the very important thing is whether industries recover well, and to what extent, because they also have implications on the subsidies or the sustainability of the company or the discoms. So those are the things. But on the long term, things tend to be fixed in my mind.
Very optimistic you are, Drusilla. I like that. But the reason that I pose this question, and then before Naba, you come in on it as well, is because the way our energy transition is different from, say, in other parts of the world, is because a lot of the renewables or the clean energy capacity is coming in the form of new and additional capacity. It's not so much a phase out, and sort of they're two parallel running stories, right? So if you just need less new and additional, does that mean that the outlook for renewables is actually, even if it's all, from a policy and regulatory point of view, it looks really good. If there's just no demand, what does that mean for renewables?
Okay, so I'm the one who posed the crystal ball narrative at the outset. So, but I'm not going to predict numbers, but I read this slightly differently, because I have been at least listening to or talking with small and medium enterprises, small businesses, etc., during the course of this pandemic. And let me just put it this way: there are, in pop psychology or whatever, there are these 5 stages of grief. The first one of them is denial. I think the major drop that we see is related to a complete, it's a shock response to something that is actually an acute crisis, but not a chronic crisis. And therefore, there is, you see this deep drop in the demand. But I think there is 2 other scenarios possible. One is general conservatism. And energy investments, as I was saying earlier and in my opening remarks, tend to be very capital heavy. And therefore, you're worried about where you want to spend money. At the same time, if you think that you need to stay in business, at least from an Indian small business perspective, where on a purchasing power parity basis, you end up having 5 times the energy costs compared to, say, a similar sized business in the United States, it actually makes sense to focus on energy efficiency or on the slightly upfront capital investments that actually keep you in business for longer. So the scenario will then play out in terms of, are you conservative about energy demand overall, or are you conservative about your own willingness to make a capital investment? Which brings me to the third scenario, which is in the stages of grief, is the final stage, which is acceptance. I think once we accept that the nature of our business has changed, or the nature of commercial transaction has changed, but our workforces will still be working. Of course, it's bad for a shopping mall, but shopping malls and hotels are not the only businesses, right, outside of the industrial sector. And I think there will be, once we accept that this is the new pattern that has changed, that might actually trigger an uptick in very new models of not just business models, but the type of investments. We tend to think in the energy sector that we want very large pools of capital going in large projects. In fact, the acceptance we might have to realize is that we now need lots of smaller investments because the workforce is disaggregated across across a large geography or at home or isolated and so forth. That doesn't mean they don't have demand. It's just that the nature of the investment changes. Once we accept that, we start then innovating on the business models or the financial models.
Yeah, no, I think that's a helpful way to think about it. I'd like to also now move a little bit, and this is something that I always find very, very interesting when I read the analysis in the World Energy Investment, is around all the investment that needs to come in sort of the infrastructure around the transition, because that's not a conversation we have enough in India. We have an energy efficiency conversation, which is kind of divorced from the renewables conversation and sometimes comes together, but we really don't always have a conversation around transmission. We do to the extent of maybe when we think about, back down curtailment, etc. But for the most part, we think that if we just install enough panels and enough turbines, then somehow we're just going to have a decarbonized electricity mix, right? But now, more recently, when the amendments to the Electricity Act were proposed, there was some amount of thinking and some amount of commentary that came in around the transmission work, but again, not enough. It was very much a distribution-focused reform agenda, which is definitely the current weakest link in the power sector overall, but not necessarily if you think about the medium or long run. So, Prashant, maybe if I can just come to you for a quick thought on this, that how do you think that what is the role of maybe public money or policy direction to then spur the same kind of general market sentiment that that renewable energy generating assets have seen in the rest of the ecosystem, whether that is ancillary services, whether that's transmission networks, whatever else. But how does that become an exciting investment opportunity for banks, NBFCs, and beyond?
Kanika, if you go few years back, government tried this very hard through a flagship program called APDRP. Okay, Accelerated Power Reforms Development Program, where they wanted to put SCADA and convert all the distribution infrastructure right up to the metering point. Okay, but the whole problem is political will, and till the time it remains a concurrent subject, these things not gonna happen. But if you take out distribution, okay, all aspects of electricity has now kept pace as far as generation is concerned, because government comes up with bids and private players participate in that, put up plants. All government needs to ensure is the timely payment, which unfortunately is not happening. But as long as government can do that bit, generation portion I'm not worried about. Transmission has also kept pace, not really bad. Transmission lines have come up fairly thick and square. The problem has been in distribution sector, and the amendment in Electricity Act, which talks about direct benefit transfer, will be the first step. The moment you do that, the electricity politics is out of the window. And the moment politics is out of the window, then there is no incentive for a state government not to privatize or not to bring reforms into a distribution sector. And if that happens, then the entire chain becomes robust, because chain is as strong as the weakest link, and the distribution was your weakest link always. And while the reforms happened everywhere else, right from transmission to generation, it never happened in distribution. So that's what I'm looking for.
Vandana?
I'm going to give a very short answer. It's kind of a flippant answer. But in terms of looking for capital, I just wanted to say that we managed to find 90,000 crores to fill a big hole as far as discoms were concerned, right? So it just needed to be directed better. I'm very, very optimistic about the changes that are proposed in the Electricity Act and the changes in tariffs that we are talking about and the limitations on cross subsidies. I'm very encouraged by the realization that the government has that if we keep industrial tariffs high, we are not going to have a make in India, which is why they're talking about manufacturing zones where the cost of power will be kept competitive. On your question on transmission, I've not really looked at it, so I don't have too much to say, except that I guess that transmission build out and generation build out needs to move together, which has been a problem.
Yeah, absolutely. So we have 5 minutes to go, and I do want to do a wrap up. So I'm going to add a few questions, and then for Lucilla and Mike to answer all of them together. Which is one, there's this general commentary, of course, around the thermal power growth in Southeast Asia or in parts of East Asia, etc. But there's really no certainty of where that thermal story goes. I mean, well, for us, where we're doing our analysis, there's actually a huge opportunity to actually phase down a lot of India's thermal assets because they're no longer economically viable. And the government seems to signal its renewed commitment towards renewables. But then there's also some signals towards supporting the coal sector. It's a part of being energy independent, etc. So I want you to maybe to talk a little bit about the transmission and the rest of the ecosystem as well as coal together, if you can, please.
So I'll answer a little bit on transmission, and then Mike can continue on the generation side and coal. And just for others or for the audience to know, we've done quite a bit of analysis on this in this year's report. And one thing that we see is that electricity grids, this is investment in both transmission and distribution, goes down in 2020 by 9%. But also it had gone down already in 2019 by 7%, and this is mainly coming from developing and emerging economies. And India is part of that story, not as prominent as others, but it is. So thinking of why don't we see enough investments, and one is that in a way, the way that investments are procured and you just simply get more money into transmission and distribution is it's sort of less plain vanilla than in the way that you see renewables. When you talk about renewables, there's a lot of tenders for various projects. Anyone without like a substantial knowledge of the power sector, for example, could sort of understand how it works and kind of what are the risks. I think that in the transmission and distribution, in part because it is a monopoly sector, but also because it is a regulated segment, there's so many more complications, and I think that and even to procure simply, normally we talk about concessions for big grids, which is very different to the classic, here is a one solar PV plant and I can see it. And actually, in terms of what can be done, I studied the case of India a few years ago. India is one of the countries where you see private sector participation in transmission. This is in the case of interstate transmission and power grid had either joint ventures with private investors, but also there was competitive bidding, and there is some successful cases, and I don't know how the last few years exactly have evolved, but this is something that even other developing countries were looking at, and that is something to open up. In many countries, private sector participation is not even allowed, and that's where, and to your point on what's the role of public sector, that's where in developing countries the role of DFIs to finance these transmission and distribution assets, basically for governments whose only way is to do it because of policy or regulation, to do it publicly. I think trying to tap into this very low rate concessional loans that multilateral or bilateral agencies can provide, it is a good idea. And that's my
Yeah, sure. Maybe I'll try to be brief on the thermal power. I mean, it's also a difficult and moving question. So you can look at various sources, and there's some 130 to 140 gigawatts of coal power that appears to be under construction around the world. Most of this is in Asia. We actually have a chart in the investment report looking at the coal pipeline over the next 3 years. And the implication is that even with all the announced retirements, based on what's under and the reduction in FIDs, based on what's under construction now, your net growth in coal is going to continue to increase. It's not going to be what it was 5 years ago, but it's around 40 to 50 gigawatts a year, and it's a young fleet in Asia. What we identified last year in the World Energy Outlook to meet the goals of the SDS and to look at the different options for coal power, I mean, essentially operators, planners, they're faced with kind of 3 different options. One is either the early retirement of coal, another is the retrofit of the coal power plants to make them operate more flexibly, which I know is ongoing in India, and different states and regulators are looking at this. And then the final is looking at carbon capture and storage in power, which we've seen relatively little investment. The challenge with looking at the thermal coal power sector, and even some countries like Indonesia and Vietnam have made signals that perhaps their future pipeline may be reduced or some of their existing plants may be retired. Lucila's working on an analysis on Indonesia. It's coming out in a few weeks. But we still see that state-backed financing is supporting about 60% of the FIDs in coal power. And this is SOEs who continue to build coal power both domestically and around the world, including Chinese SOEs, and the influence of some major policy banks and export credit agencies that continue to finance, even though a lot of the commercial lenders have essentially dropped off financing coal power.
Great, thank you. I mean, I think that this was a very rich discussion. I'd like to thank all of you, and I think it's very difficult to do any kind of a roundup. And so maybe I'll end with what is my outlook, since now you guys can't ask me any questions, so I can just say whatever I like, which is to say that there is really no option but to be optimistic at this point. And so, of course, the markets don't look as good as they did perhaps in January or even in the last quarter of last year. And then there were challenges then, and there are going to be challenges now and in the future. But it is really for us to think about the opportunities that the sector that are available in the energy and in the power sector. And clean energy or renewable energy in the Indian context continues to be the opportunity that is the best in class, so to speak. It still gives you the best returns, and it can be the kind of nugget, so to speak, that can drive the recovery and the economic growth. And again, to talk about the report that we just came out with yesterday, jobs growth and sustainability, actually renewable energy projects are very much sort of the poster child of driving that kind of growth. So the outlook for India sort of continues to be dampened by COVID, but not at all in a way that is market breaking. And so and then there will be soon very specific renewable energy for India kind of trends analysis that the IEA and CW does every year that we will come out with. But till then, thank you very much for your time, and have a good weekend. Thank you.
Thank you all.
Thank you.
Okay, thanks, Kanika. Bye.
To all the participants, there are some questions that were left unanswered. We will try our best to answer them and send you the slide deck as well as a recording of this session. Thank you very much for your time.
Bye-bye.
Bye.
Bye.